A few years ago, everyone ignored SoFi stock, but they continued to scale, growth accelerated, and margins improved. Now we're looking at one of the best fintech ecosystems in all of the United States. But there's another company following a similar path, and no one is paying attention. Now, that company is Chime, ticker symbol CHYM. Now, they're a recently IPO'd company just in June of 2025, but since then, the stock has fallen over 60%. At the time that they IPO'd, I was a little bit hesitant to invest in the company because they were more expensive than SoFi while growing slower than SoFi themselves. I thought that that was completely mixed up, but since then, SoFi has nearly doubled and Chime has got cut in half. Now, the pricing is completely different and Chime might be an amazing opportunity. So in this video, I want to go through a presentation to talk about what Chime does and why I'm putting some money here at these levels. First off, Chime is a solution for bad banking. The high majority of people end up having to pay large amount of fees, not have access to good credit, and they need help building credit. That's the high majority, about 200 million Americans. Chime wants to solve those problems. As you can see, first up, the major thing is that there's no fees at Chime. Overdraft fees, minimum balances, no monthly service fees, it's all completely free versus the large banks. They're also developing products at a very fast pace and literally following in SoFi's footsteps, like Chime Workplace, which is very much like SoFi at Work, or developing Chime Core, which they were actually Galileo's largest client. Then they created their own version of Galileo. Chime Plus is very similar to SoFi Plus. Instant loans, access to paychecks much earlier, all of these things following in SoFi's footsteps. Member growth resembles a very similar trend to SoFi's total member growth. Now, this is active member growth, meaning that these members are making some form of a revenue generating activity in the last 30 days. Okay, so you can see that at 8.7 million users, which is smaller than SoFi, these are their active users. These are people that are actually on the platform constantly. And that growth rate has actually held up still in the 20+% ranges. And they're actually expecting quite the acceleration in Q3, but we're going to talk about that here in a second. I also wanted to highlight Chime Workplace, the SoFi at Work sort of competitor, which is actually very interesting. And they expect a large amount of growth coming from this channel, but it's brand new. So right now, you're not going to see a lot in 2025, but they are expecting a huge ramp in 2026 for new member ads. Remember, Chime is not trying to go after the same user as SoFi. They're really trying to go after the average American that's making under $100,000 per year. SoFi usually tries to aim above $100,000. These people are coming from the large banks where they have not been well served, and yet they end up switching over to Chime for their direct deposits very quickly and are using Chime on a monthly basis about 54 times per month to make some sort of transaction, whether that's a debit transaction, unsecured credit, some form of an e-transfer, sending money to someone else. And people continue to spend that same amount every year because all of their spending is non-discretionary. Usually this is for food, groceries, gas. So we know that this spending can continue to keep up. So Chime's revenue is growing much faster than their overall total member base. So now we're actually seeing growth accelerate from 20 plus ranges all the way up to 37% just last quarter. Massive acceleration year over year. Now, the interesting thing that makes this very different from SoFi is how capital light this business model truly is. Okay. And you also see that in their balance sheet as well. Chime has nearly zero debt and over $1 billion in cash because they don't really need a lot of cash to do much. This is payment-based revenue that is extremely capital light and very high margin. They also show off their purchase volume and their members, so we can find what their take rate is and how much money they're making per user. And that stayed completely flat on the take rate part, but on the per user basis, this has also continued to climb. So not only are we actually getting more and more users on platform, but those users are making more for Chime over time, which is also very exciting. The average revenue per active member is expanding with the amount of products that they actually create. So for example, they showed off, hey, from Q1 of 2024 to Q1 of 2025, yes, average revenue per member did increase by $20, but for the people on the platform that have 6+ products, that average revenue per active user is at $442. And as people come on and spend more time on the platform, their average revenue per user goes up Okay. Meaning that people are strengthening their relationships on Chime. And the only reason why it's actually lower than it is currently is because they're gaining so many new members on the platform, which is holding the average lower than the really seasoned cohorts that have been on for long periods of time. And because of the payments nature, extremely high margin, what you end up seeing is gross profit and their margin continuing to expand in the high 80% marks. So we know more users are coming onto the platform. The more products that they have per member ends up leading to higher average revenue per member, and those products are very high margin. Well, members are actually taking out more products at a much faster and faster rate. So each year they've gotten better at getting people to multiple new attach rates. And each and every quarter and every year, that's getting better. And they don't have to change their strategy at all because they have massive pricing advantages. Unlike, traditional banks that have branches and have to pay for security and the ability for people to walk in and get talked to by a real person, obviously all of that costs additional amounts. Well, Chime doesn't have that. So they can cut the costs, allowing them to give more products that people actually want at lower costs because they don't have to pay for those additional services, allowing people to sign up quicker and then also tell their friends about it because it's working so well. And over time, things just get better with scale because either they end up using better vendors that end up pricing better depending on the amount of members that they're bringing on. They get pricing advantages. They are working harder to improve their back end. So the percentage of total operating expenses continues to lower as a percentage of revenue. And that's expecting to radically continue to drop. And just to show you guys how their expenses break out, yes, it's mainly focused on sales and marketing because they already know that they have tools that fit, the high majority of Americans much better than traditional banks, but it's just about awareness and trying to get their name out there. So that's going to continue. They just did a campaign today with Jason Momoa. They know their target audience, so they're going to continue to push in that direction. But like I said, the real reason why I'm focusing on this company right now is the valuation difference. Currently, they're not profitable on a net income basis or really even an EBITDA basis. But on a price to sales versus SoFi, at the time that they IPO'd, I was really perturbed by how much more expensive they were to SoFi. SoFi has since done an amazing job at expanding margin and making a lot of SoFi investors very rich. Chime has quickly devolved into being quite a mess. Okay. But that's led to a price to sales under 4 times for a company that's growing revenue above 37%. Members are coming onto the platform, active members, and they are getting more operationally efficient. That has led the difference in their pricing to be, at one point, Chime being more expensive to being almost a third of the cost of what SoFi is for probably doing 75% as well. I mean, the pricing is just completely off here. Chime is improving their back end and just finally starting to break out into some adjusted EBITDA profitability quarters. However, in their latest earnings call, they said, our guide is calling for a return to mid 40s as a percent or higher incremental adjusted EBITDA margin by Q4. Incremental, meaning all the new adjusted EBITDA dollars that are coming on will be at 40+% rates. So don't expect them to get to 40+% rates, but over the long term, that's how they see sight into getting to 35+% long-term adjusted EBITDA margins to the business. That's extremely efficient and even higher than where SoFi is. And the total addressable market is so unbelievably big for the average American population of 196 million Americans. Right now, yes, the average revenue per user is roughly about $442 if they get to 6+ products per user. But imagine installment lending, unsecured credits like a regular credit card, long-term savings, investing, insurance products, enhanced member rewards. They think that they could almost 4x the amount of average revenue per user that they could get on a per member basis. And they have aspirations to then jump into the higher end, premium features and premium pricing to try to compete with the SoFis and, the higher end products. Doesn't mean that they'll succeed, but it's this area. It's the $312 billion that I do think that they will have a large percentage of. And traditional banks have it coming from every side. So there's going to be multiple winners, and I think Chime will be one of them. To add a couple more cherries on top just to sweeten the deal for me, what we end up seeing is that Chime's website traffic and app downloads have skyrocketed in Q3. Okay. So what we ended up seeing was the last 4 quarters doing okay, but then just like SoFi, seeing an immense bloom of growth in the last 3 months. And Wall Street is completely for this name. There's no credit worries. They're not even a bank. No one is worried about credit problems. This is completely a payments name. So it's just a matter of if people actually like their brand name and want to keep using it. So the average 12-month forecast of this company is $37.83, or 105% upside from where we are as of the time of recording this video. To me, I find it very rare that Wall Street, as a consensus, thinks that this company should double from here over the next year. No one is okay with this valuation under $20 per share, and everyone is calling for much higher going forward. So if I'm right, and if this is a quick payments name that is attracting more and more members, we are seeing some sort of large sell-off that is not aligning itself with the bull market that we're seeing across the rest of fintech. We're getting an opportunity to buy into a name that's still pretty good, but yet completely sold off and ignored. Let me know what you guys think, and if you guys have any problems with Chime in the comments down below. But until next time, bye for now.